We see ourselves as global real estate investment managers. The fact that it's listed is, I think, too much focus or emphasis is placed on listed. It's real estate that ultimately the underlying real estate is what we focus on. We see ourselves as real estate investors. We look around the world for the world's best real estate platforms with outstanding management teams, strong, robust balance sheets. But what we've found over the medium to long term is that whilst in the short term there's some volatility, which I'll come back to, over the medium to long term, the REITs in fact do perform as real estate, and that's because it is the underlying real estate that matters. What you get in the shorter term is some volatility associated particularly with liquidity. That's the great thing about REITs. You can get your money back if and when you need it. And we've been managing money in listed real estate for near on 25 years. We've never suspended redemptions on any of our funds because all of our funds are in listed real estate, which means, again, you can get your money back if and when you need it. Now, what happens with listed real estate is that, yes, sometimes it does diverge from an NAV or a net asset value. That NAV could be wrong. Or alternatively, what it means is that the REIT can be relatively good value. And so what happens is that gap will ultimately close. And we will, again, come back to that issue shortly. But ultimately, as I say, we see ourselves as investing in real estate that just so happens it's listed. You'll see that it's a fantastic opportunity set of a diverse range of real estate categories. Office, residential, industrial, healthcare, retail, diversified vehicles, as well as some smaller niche areas such as self-storage, data centres and cell towers and hotels. Now, what we also should point out is that geographically it's also quite diverse, so we can invest in leading or major developed markets around the world, the US, Europe, UK, various parts of Asia, Japan, Singapore, Hong Kong, Australia, etc. So it's a fantastic global opportunity set that truly provides diversification and, as I say, liquidity. Now, the next word perhaps is the word of the day, fungibility. What that means is it's interchangeable, which highlights why the NAV gap between listed and the underlying real estate's exposures will ultimately close. And that is because these vehicles, all they really do is own real estate. If somebody is actually trying to buy the direct real estate, they might actually consider buying the listed REIT. So that's what the private equity guys do. They will look at the value of the REIT, real estate, and compare that with what's available in the direct market. And if the REIT is trading cheap based on its underlying assets relative to the value of the real estate markets, they will take it private. And so it is, as I say, interchangeable. You can own it to buy the underlying real estate. It's fungible. It also enjoys other benefits, which are probably the most important, which relates to return and the income profile. So what I think is probably underappreciated is that over the long term, the global REITs have actually produced very competitive returns with global equities. Now, this is point in time of 25 years. I think that you'll find that over various measurements, REITs in fact do provide very competitive returns. And the good thing is that, as you can see on the slide on the right, a substantial component of that return is derived from income. I think what we've found over the years is that people overestimate the equity's earnings capacity and underestimate the cash flow from real estate and the long-term value opportunity. Now, we do see it as a store of wealth that can hopefully grow at least in line with the rate of global inflation over the medium to long term. So it's these characteristics that to us mean that the global real estate opportunity set in the listed market is quite fantastic. One of the things that continues to unsettle us is this fixation about REITs and interest rates and the bond proxy discussion. Look, we do not dispute for one moment that interest rates matter. Of course they matter. They are the reference point for investment, to all investments. The reason why REITs do well or poorly against interest rates is determined by the underlying fundamentals of the asset class. Now, if it's all about yield, as many people, and it's bond proxy, as many people have been suggesting about REIT performance, I'm curious to understand why in the last 5 years we've seen record prices achieved for vintage cars, classic cars, stamps, bitcoins, and more recently the run up in the gold price. What's the yield on those investments? There is no yield. Reality is that they have been pushed up in value because of lower interest rates. Lower interest rates in QE was meant to push up asset values and inflate the global economy. And it's the fact that REITs have done so well is not because they're a bond proxy, it's because they've actually produced very, very attractive total returns in the form of income yield and earnings growth or cash flow growth. This chart on the left, you can see in relation to occupancy and rent growth, that's the fundamentals of real estate. And what you can see there is that the blue bars is the occupancy of US portfolios. And they've been enjoying near record levels of occupancy. And that's been pushing up rents. Landlords have had pricing power. And that's a key to the underlying asset values and how they'll perform. So that to us has been a fantastic situation. And what we're also, I guess, encouraged by is that the biggest threat to real estate values relative, and I stress relative to other asset classes, is the supply and demand picture. Now the demand picture relates largely tenant demand, which relates to the economy. And that relates, or that's a common characteristic or a common thread across most investments. You are worried about economic growth and demand drivers. It's the supply side that really will distinguish how real estate performs. Because if obviously you see an oversupply, doesn't matter what interest rates do, if we see an oversupply, a flood of construction activity, we will see downside pressure on rents. And therefore landlords lose pricing power, and therefore they are no longer an attractive investment to other asset classes. So what we've got is we've got a period of relatively high occupancy, as the chart on the left demonstrates. But the chart in the middle, I think what is pleasing is that supply levels, construction activity, has been relatively constrained. I think the line to focus on is the red line. That's the percentage of stock or a building that's taking place as a percentage of the overall market. And you can see that it is still at below historic averages, despite being 8 years, 9 years into an economic growth phase. Now, if you look back in time, if we look further back, this far into a economic cycle, we usually have quite elevated levels of supply, which again is a real worry because the risk is that you see an overbuilding, therefore vacancy levels rise, therefore landlords lose pricing power. It's not the current situation. So at the fundamental level, in the underlying real estate markets, we have high occupancy and moderate supply. That puts us in very good stead to continue to generate reasonable rent growth. Other area that real estate and REITs have gotten into trouble in over the years is when they take on too much debt. Of course, in the financial crisis, that was very much the case. The outcome of what was going on in the residential market, too much debt, and the effects through to the rest of the commercial property market, including REITs. Now, they had REITs around the world and the US had leverage of around about 35 to 40% loan to value. Now, the great thing is about REITs today, you can see on the chart on the right, is that they haven't been encouraged, despite these low interest rates, to go out and leverage up and take advantage of low interest rates. They've actually deleveraged, which from what we understand what's going on in the corporate equities market is quite the opposite. Corporates have been leveraging up, taking advantage of low-cost, low-interest rate debt to boost their short-term earnings and pay themselves bonuses based on targets of earnings per share growth, etc. So the REITs have deleveraged remarkably, despite the very good real estate conditions. So that tells us that the REITs, real estate and commercial real estate, is in relatively good position to withstand a change in economic conditions. If you have a look at those top charts, that's basically your demand and supply picture. You can see that is generally reasonably steady, which leads to tenant expansion, which leads to absorption of space. There's not too much space. And what happened after the financial crisis? Construction activity turned off, and it's only just recovered to as I say, really just about a long-term average. So this is very pleasing. But again, it's that bottom slide you can see on the bottom left. Rent occupancy is now at or near record highs. On the chart on the bottom right, you can see the rental growth history. There will be volatility associated with economic contraction and overbuilding, but at the moment, as I say, the picture is pretty reasonable. And again, on the debt picture, you can see that what the REITs have been doing, it's a repeat of the slide from previously, where the REITs today, the leverage is on average about 30% loan to value. What they've been doing is far more actively recycling capital. That is selling assets to invest in better quality property, sometimes through development. They've also been, when share prices have been soft, doing share buybacks. They've been pushing out debt maturities. They've been undertaking term debt refinance. So, for example, last week, a couple of the REITs were borrowing 30-year money at what, 1.5%? That's right. And so they've been taking advantage of low interest rates to actually and debt markets to push out debt maturities, because during the financial crisis, US in particular, it wasn't the debt level, it was the debt maturity that was the major issue for a number of REITs when they had too much short-term debt maturing. So they've all been pushing out their debt maturities into a far healthier position. So the great thing is the REITs have got the financial flexibility to undertake a number of initiatives to enhance value. They could leverage up in the future. That's not our preferred course. Do share buybacks if the price is cheap. They can do mergers. They could, as I say, they've got lots of levers they can pull to drive earnings from a relatively strong financial position. So what are the issues that worry us and concern us as being the major issues in the real estate market today? Residential affordability is a massive issue in many of the world's cities, major cities, from New York, London, Berlin, Sydney, Tokyo, Hong Kong. It's been obviously a flashpoint. It's been a major issue behind some of the tension there in Hong Kong recently. Now, what we've seen is, ironically, after the housing crisis, the subprime crisis, we've seen a lack or insufficient supply in the major markets. And as a consequence, house prices have been growing, and with limited wages growth, the affordability crisis has become quite significant in many of these cities. This head also in markets such as Berlin. There's currently legislation before Parliament for a 5-year rent freeze for residential tenants in Berlin. Now, we see this as counterproductive. Ultimately, this will only exacerbate the problem, and that is a housing shortage created by insufficient supply. But what this will do is, as I say, reinforce in Berlin, kick the can down the road. Yes, it'll make tenants feel good in the short term, knowing that they don't have rent pressures. But in the long term, it means that there's going to be deterioration in the residential housing stock because landlords will not invest in new product. And so therefore, the existing product will continue to disintegrate or deteriorate. The housing stock will not meet the demands of tenants ultimately. So this is a major issue. We're also seeing in the US, ironically, the home of the free market. New York, there's been changes in rent legislation just recently, protecting some older buildings from increasing rents. Whilst on the West Coast, in California in particular, there's an acute housing shortage in markets such as San Francisco and Los Angeles. And again, there's calls for rent controls in those markets. So this is going to be a major issue for global property markets. The other thing which is pretty clear is the effect of e-commerce on retail, and that's creating challenges for shopping centre owners. We continue to believe that high-quality shopping centres, flagship malls will continue to do well, but they are going through a transition phase as they're having to change to meet changing consumer spending patterns. So as a consequence, you've got key areas such as fashion under enormous pressure, and so you're seeing fashion tenants having to downsize or recapitalise their, re-engineer their businesses to allow for omni-channel. So there's a transition phase going through for property. Now that has been obviously most acute in the UK, and I know South Africa has fairly good understanding of that challenge with a number of vehicles such as Into and Hammerson undergoing significant challenges through this phase, principally because of that. But the problem that they've got is that they've gone into this transition phase with very poor balance sheets. Again, highlights to us the need to have strong balance sheets, able to transition the portfolios to meet these changing consumer spending patterns. The other thing that concerns us is along tenant credit. Look, tenant credit basically means business profitability. What with QE and low interest rates is that there's been a number of startup businesses being able to get to fairly significant size without a proven profitable business. At the moment, the headlines of the likes of WeWork and more recently Uber, examples of businesses that aren't profitable, been propped up by low interest rates and time, because what's the pressure? Interest rates are low, we might as well leave the money with these businesses and hope that they can actually turn a profit in the future. So in other words, they're vulnerable to changing credit and interest rate environments. And that is an issue that I think we should be all cognizant of when we're considering our investments. So then how are we positioning? You'll see that our portfolio is reasonably diverse. We've got very substantial exposures to the residential market, which, as I said earlier, we're seeing a shortage of residential building, which is leading to high occupancy and rent growth. Now, most of our exposure is in North America, in the US and Canada, in markets such as Toronto, New York, Washington DC, Boston, Seattle, Los Angeles, and San Francisco, markets that are enjoying rent growth in the order of around about 3 to 4% at the moment. Have an exposure to, a meaningful exposure to select office markets. Maybe you should talk about the office.
Yeah, so we're seeing record low vacancy rates in a lot of office markets around the world, including here in Sydney and in Japan. We're also seeing very strong growth in the technology-led markets like San Francisco. It's important to point out that within that office positioning, one of the largest positions that we have in office is actually, it's Alexandria, which, you know, the index office decides to call it or categorise it as an office stock. But we often think of it as a healthcare stock. And that's because it does have office buildings, but they are almost exclusively leased to life science type of tenants. So it's, for want of a better term, it's lab space office in markets like San Francisco and in Cambridge, Massachusetts, and New York and San Diego. These are markets that have got a combination of very strong technology drivers as well as life science drivers. because they're adjacent to learning institutions like MIT and various other universities. So that's within the office category. It's one of the largest positions that we have in the office category, but as I say, in many other respects, it can be regarded as a life science or healthcare stock. And so, as I said, we're very low vacancy rates across many office markets and reasonably good rent growth. We also have some exposure to New York, which is seeing a bit of some challenges, but we can see some reasonably good deep value within the New York office market. And so that's an aspect that we find interesting as well.
You see, we're holding reasonably high cash levels if we look at it on a regional basis. Look, we think the fundamentals are fine, but it's fair to say, as we'll touch upon a little later, multiples are elevated, and therefore we're holding a reasonable cash position. Our cash position is usually in the order of 3 to 4%, and it's currently a little more elevated than that. And so we've been waiting for some sort of correction, given the tailwinds lately have been fairly strong, and so we're holding a little bit of cash. But geographically, in terms of where we are exposed most, it's to the US, which is over 50%, it's about 57% of the portfolio, and overweight relative to the benchmark. Our biggest underweight is in fact to Japan. It's actually to the Japanese REITs, which we don't see as being value adding. They've been benefiting from a number of factors, including the Bank of Japan, as part of their QE, has been actively buying the J-REITs. For that it's all about designed, again, to push up asset values, to get the capital markets and real estate markets velocity of capital increasing, and therefore promoting investment, etc., in an economy that's obviously been moribund for an extended period of time. We're also a little underweight Europe. We tend to find there that European REITs have relatively high leverage, and most notable in that camp is Unibail-Rodamco. That is a stock with a very good quality portfolio, going through a few challenges in the short term, but unfortunately going through those challenges with a compromised balance sheet. And so that's why a stock like that has been a major factor behind our underweight exposure to Europe. And that is a look at the actual vehicles in which we've invested. You can see here that the biggest exposure is to a stock called Prologis, which we'll come back and talk to in a little while. But again, a broad range of different office real estate categories there: residential, healthcare, office, data centers, Interaction, which is a European-based but New York Stock Exchange listed data center owner. So to us, these highlights the quality, or certainly the substantial investments we have, we consider to be a very high quality list of vehicles. When we talk about REITs, I don't think, if we talk about global equities, I think most people would be fairly familiar with a number of stocks included in most global equities portfolio, whether it's the FANGs or it's Procter and Gamble's or the Microsofts, or the you'd be familiar with most of the names. But when we talk about global REITs outside of our own neck of the woods, so beyond the growth points and the redefines, etc., most people wouldn't be that familiar with global real estate opportunities. Now, what we thought we'd do is just highlight some of the names that we look at. We're not suggesting they're necessarily great value today, but just giving you an idea of the quality of opportunity set that is available to us. And the first one is a stock called Assura. Now, it is in the UK. It's a stock that we've held in the portfolio, in Net's portfolio, since day one and beyond, in terms of within our long-standing portfolios. We've held this stock for over 5 years. What's important about this stock is the defensive nature of the cash flow. It's NHS-backed leases to doctor surgeries around the UK, 555 odd doctor surgeries around the UK with long-term leases. with an average remaining term of 12 years. Now, given all the uncertainty associated with Brexit, this is the sort of cash flow that people treasure in periods of uncertainty. And it's worth noting, this stock is up over 20% since the eve of Brexit. And remember, this is the eve of Brexit when Brexit wasn't expected to occur. And this stock's up over 20%. So again, if you can focus on the underlying fundamentals and the quality of the cash flow and the strength of the balance sheets, these sort of cash flows become, as I say, treasures during periods of uncertainty in challenging economic and political times.
Prologis owns industrial warehouses, predominantly in the US, Europe, and some in Asia. As an example of a segment of the business of the real estate landscape and landlord that is enjoying structural demand from e-commerce, obviously to the detriment of retail landlords. The retail landlords are suffering because of e-commerce, and the warehouse landlords are benefiting. And one of the most important drivers of this demand for warehouses has been that consumers are demanding faster and faster delivery times. Those that were done 5 or so years ago, people would say that when they're shopping online, they're happy to take delivery within 3 to 4 days. This year, Amazon has announced that they're going to target 1 day free delivery in the US for Prime members. And so what that means is that e-commerce providers or e-commerce companies like Amazon need to be located very close to the population, within large population centres, right on the urban fringe. And you might be familiar with many cities around the world where, right on the urban fringe, where you had traditionally some warehouse space, a lot of that has been converted over the last 10 or 15 years into higher and better uses, or they were thought to be higher and better uses at the time, such as residential uses. And so what you've seen in many of these markets just on the urban fringe is a contraction in the amount of warehouse space at the same time that you've seen a big increase in demand for that very warehouse space. As a result, companies like Prologis are seeing very strong pricing power, very strong rental growth pricing power. And in fact, Prologis' portfolio has about 15% upside from their current contracted rents to where they see market rents and where they're signing new leases. And that's generated very strong rent growth and therefore earnings growth for Prologis. Last 8 years has been 10% per annum compound. And they do that with a relatively conservative balance sheet, 25% loan to value ratio. And importantly, the entire, almost the entire universe of industrial stocks has performed very strongly in this environment. What we're looking for in our process is looking for the best risk-adjusted returns. There's been some very strong performance from a stock listed here in Australia called Goodman Group. We think they're a great company. They're doing a very good job.
It's the global rival to
Prologis, yes. We think they do a great job, but the nature of their business is much more focused on development and funds management, which has at the moment, a lot of performance fees in it. And there's just not the resilience in the cash flow, we think, in the downturn. Whereas in the case of Prologis, even though they do development and they do funds management, it's a far less proportion. It's less than 15% of their earnings. Whereas in the case of Goodman, it's more than 60% of their earnings is coming from those other activities. So we have a large position in Prologis, even though we like a company like Goodman, much better risk-adjusted returns from a company that's got much more recurring rental income streams in this very popular sector.
Another sort of unusual stock, which we've had a long-standing investment, Equity Lifestyle. People hear of trailer parks more euphemistically, or dare I say it, some people might call it trailer trash. In fact, we like to see it as trailer cash. Now, what's unusual about this vehicle is that it's affordable residential. But the great characteristic here is that the vehicle owns the underlying land, not the buildings that you see on the picture. Now, we've toured a number of these properties. They have to be in very attractive locations, coastal quite often, sometimes on golf courses, on lakes and other natural parks or natural features that make it a very attractive place to live. And for a number of people in the northern parts of the US, they're called the snowbirds. They go south for winter, go to these warmer climes to live in what is relatively affordable accommodation. And as I say, we to see them, they're attractive locations, and the building quality is actually surprisingly good. In fact, many of the houses are built by a company that's owned by Warren Buffett's Berkshire Hathaway. What happens is the occupant buys the house and literally dumps it, or I shouldn't say dumps it, places it on the land and pays Equity Lifestyle a rent for the land space. So that means that Equity Lifestyle is not responsible for replacing the carpets and the kitchen and the bathroom and the roof and repainting and all those things that people take for granted when you're owning a property that is escape cash flow. So Equity Lifestyle literally just takes the cash for the underlying land, and therefore there's very low depreciation. Affordable living, as I say, a strong balance sheet, and the stock has produced outstanding long-term returns. And it's that fundamental issue of limited amounts of supply and strong balance sheets on demand that leads to exceptional returns. You can see the current portfolio, or at 30 June, was around about 43 securities. The implied cap rate was 5%. That is, yield on the investment, on the property, the underlying property was about 5%. And what do you think, Marco, to replicate that portfolio today, if you were to try and go out and invest in the underlying real estate, what sort of...
Yeah, to be, 10%, under...
So 4.5% yield.
Yeah.
So in other words, you're getting a large, high-quality real estate portfolio at 5 to 10% discount to the underlying assets with an outstanding management team. We don't take for granted that what we're investing in is real estate that's managed by best-of-breed managers who are focused on extracting the most they can from the underlying land. You can see the occupancy at 94.5%. The general feeling is landlord pricing power is above, when occupancy is above 93%. So at 94.5%, landlords have the balance of power when it comes to lease negotiations, provided there's not too much supply coming through. Current dividend yield is around about 3%, which is obviously relatively low by South African standards, but obviously given interest rates around the world, that's still deemed to be quite an attractive income component, particularly when we take into account the payout ratio is around about 80%. So as a consequence, dividend is reasonably sustainable and should continue to grow unless, of course, we have a very significant economic contraction. If that's the case, all bets are off, but at least the REITs are in relatively good position to be able to withstand those conditions. As you can see, the balance sheet, we look at it on debt to EBIT. We think that's a better measure for leverage than loan to value. Our current portfolio loan to value or net debt to EBITDA is around about 4 times. That is exceptional. That's equivalent of about 20 to 25% loan to value. So it's quite a strong balance sheet that the overall portfolio has. Now, we like to think long term, and you can see that by investing in high quality real estate with robust balance sheets, focused, aligned management, you're able to achieve what we think to be pretty acceptable returns through cycle. And that's the critical issue here. We have to think, the last 2-3 years have been fantastic, no question about it. In fact, the last 10 years have been exceptional. We have to be thinking about through cycle. Hopefully, yes, we will see drawdowns. I'd like to call this a total return investment category, absolute return, I should say. But reality is that in the shorter term, you are going to see challenging conditions. Now, quite often, that's a great opportunity to put more money in. But at least with listed, if you need the money, you can get it.